Welcome to this tutorial session where we will be applying the principles of IAS 16 to solve real exam style questions. But before we start solving questions, here is something important. If you haven't yet watched our previous lesson explaining the theoretical principles and key concepts of IAS 16, pause this video right now and click the link showing in the top right corner of your screen to watch that first. That lesson will give you the foundation you need to follow along easily with this practical session. The first two questions will test our understanding of the cost to be capitalized at initial measurement. The standard IAS 16 states that an item of PPE should initially be measured at cost. The cost will be made up of the purchase price plus directly attributable costs less discounts and rebates. The cost at initial recognition should also include dismantling costs. The present value of these costs should be capitalized with an equivalent liability setup. The discount on this liability would then be unwound over the period until the dismantling costs are paid. This means that the liability increases by the interest rate each year, with the increase taken to finance cost in the statement of profit or loss. You may need to use the interest rate given and apply the discount fraction to get the present value of the dismantling costs. Question 1. Majesty Energy constructed an oil rig in the sea. The asset cost 10 million Ghana cedis to construct. It would cost 4 million to remove in 20 years. Required. If interest rates were 5%, in accordance with IAS 16, calculate the present value of the dismantling cost, the total cost of the asset to be capitalized, yearly depreciation charge, the dismantling cost liability at the end of year 1. A. The present value of the dismantling cost. We'll calculate this using the discount fraction 1 over 1 plus R exponent n, where R is the interest rate and then N the number of years. We are going to discount 4 million Ghana cedis, 1 over 1 plus R, which will be 1.05 exponent 20, and this will give us 1,507,558 Ghana cedis. B. The total cost of the asset to be capitalized. This will be the cost of construction, which is 10 million Ghana cedis, plus dismantling cost in present value terms, 1,507,558 Ghana cedis. And this will give us a total cost of 11,507,558 to capitalize as the total cost of the asset. Yearly depreciation charge. The useful life of the asset is 20 years. So we are going to spread the total cost over 20 years to get our yearly depreciation charge. And that will be 11,507,558 divided by 20. This will give us 575,378 Ghana cedis per year. The dismantling cost liability at the end of year 1. Each year, the liability would be increased by the interest rate of 5%. So let's get that down. That will be the present value of our dismantling cost, 1,507,558 times 5%. This will give us 75,378. To get the total cost liability at the year end, it will be the interest, which is 75,000, plus the present value of the dismantling cost, 1,507,558 plus the interest, which is 75,378, and this will be 1,582,936 as the liability at the end of year 1. Let us note that the interest of 75,378 is taken to the finance cost in the statement of profit or loss. This is everything for question 1. We calculated the present value of the dismantling cost, the total cost of the asset to be capitalized, yearly depreciation charge, and the dismantling cost liability at the end of year 1. Question 2. Before we read the question, let us know what is required of us. What is the cost of the asset to be initially recognized in the PPE register, and what amount should be charged in the income statement relating to the consumption of the economic benefits embodied in the asset for 2015 financial year? Let's read the question. As we read, we will take note of the cost that will come together to give us our cost at initial recognition. You have just been appointed as the financial accountant of Majesty Nuts. On 1st January 2015, Majesty Nuts acquired a production equipment with a list price of 250,000 Ghana cedis. The following costs were incurred: delivery, installation, general administration costs of an indirect nature. The standard IAS 16 states that initially costs should be measured at the purchase price plus any directly attributable cost and then dismantling cost. General administrative cost is of an indirect nature and as such will be excluded. We will include the delivery and installation. The installation and setup took 3 months and a further amount of 21,000 was spent on costs directly related to bringing the asset to its working condition. This is the key word. Directly related to bringing the asset to its working condition. We will include this as well. The equipment was ready for use on 1st April 2015. Monthly managerial reports indicated that for the first 5 months, the production units from this equipment resulted in an initial operating loss of 15,000 because of small quantities produced. IAS 16 states that initial operating losses before the asset reaches planned performance should be recognized as an expense. So the 15,000 initial operating loss will not be included in the cost of the asset. The months thereafter show much positive results. The equipment had an estimated useful life of 10 years and an estimated residual value of 18,000 Ghana cedis. Estimated dismantling costs amount to 12,000. Dismantling costs will form part of the cost of the asset. We will use the residual value to get our depreciable amount for depreciation. So from this, we know our cost to capitalize will include the price, 250,000, delivery cost, 18,000, installation, 24,000, directly attributable startup cost, 21,000, and dismantling cost, which is 12,000. This will give us a total cost of 325,000 to capitalize at initial recognition. The second part of the question required that we determine the amount that should be charged in the income statement relating to the consumption of the economic benefits embodied in the asset, and that is our depreciation charge for the year. Depreciation is given by the cost less residual value divided by the useful life. The cost of the asset, 325,000 less the residual value, which is 18,000, divided by the useful life, 10 years, 9/12. We are using 9 out of 12 months because the asset was available for use on 1st April 2015. 1st April to 31st December is 9 months. Our depreciation charge for the year will be 23,025 Ghana cedis. This is everything for question 2. I would want you to test your understanding with question 3. You are required to advise Majesty Limited on the costs that can be capitalized in accordance with IAS 16. Leave your answer in the comment section. Questions 4 and 5 will test our understanding on measurements subsequent to initial recognition. IAS 16 offers 2 possible treatments here. Essentially, a choice between keeping an asset recorded at cost or revaluing it to fair value. Under the cost model, the asset is carried at its cost less accumulated depreciation and any accumulated impairment loss. Under the revaluation model, the asset is carried at a revalued amount, being its fair value at the date of the revaluation, less any subsequent accumulated depreciation and subsequent accumulated impairment losses. Question 4. A. Determine the depreciable amount. Depreciable amount is the difference between the cost of the asset and the expected residual value. This is 100,000 less 40,000, giving us 60,000. This is our depreciable amount. B. Yearly depreciation. The depreciable amount is spread over the useful life, which is 6 years, to give us our yearly depreciation charge. This will be 60,000 divided by 6 years, and we will have 10,000 per year as our yearly depreciation charge. C. We are to show relevant extracts from the financial statements at the end of year 1. Begin with the statement of profit or loss extract. Under expense, we will have our depreciation charge for the year, 10,000. This will be all for our statement of profit or loss extract. In our statement of financial position, our extract will look like this. The cost of the asset, which is 100,000, and then the accumulated depreciation, which will be 10,000 for year 1 depreciation only, giving us a net book value of 90,000 Ghana cedis. This is how our statement of profit or loss and statement of financial position extract will look like. Question 5. This question will test our understanding on revaluations. Majesty Limited has an item of plant with an initial cost of 100,000. At the date of revaluation, accumulated depreciation amounted to 55,000. The fair value of the asset by reference to transactions in similar assets is assessed to be 65,000. You are required to pass journal entries to record these transactions and determine the carrying amount of the asset. A. The first journal entry we will post will be to eliminate the accumulated depreciation against the cost of the asset. So we are going to debit the accumulated depreciation account with 55,000 and then credit the asset account with 55,000. And our description will be being elimination of accumulated depreciation against the cost of the asset. The next journal entry will be to uplift the net asset value to fair value. The initial cost of the asset is 100,000. We credited that with the accumulated depreciation to reduce the value from 100,000 to 45,000. Now, at the revaluation date, the plant was assessed to value 65,000. The difference between 65,000 and 45,000 is 20,000. We are now going to debit the asset account with 20,000 to lift the value from 45,000 carrying amount to the fair value of 65,000. Debit the asset account with 20,000, and we are going to credit revaluation reserve with 20,000. Now, the description will be being uplift of net asset value to fair value. So these are our relevant journal entries. The B part, determine the carrying amount of the asset. The net result is that the asset has a carrying amount that will be determined as follows. The original cost, which is 100,000, less the 55,000 accumulated depreciation, plus the 20,000 revaluation gain. And that will be the carrying amount of the asset, 65,000 Ghana cedis. That brings us to the end of the first part of our practical session on IAS system. I hope this tutorial helped you see how the principles we discussed earlier actually apply in exam questions. In the next tutorial session, we will account for revaluation gains and losses and depreciation of revalued assets.